Well, howdy there, folks. Welcome back to the channel. So what better way to get a bunch of views than to talk about my favorite covered call ETF, QYLD, again. And it's very good timing on this because at the end of last month, April, it just paid out another really good dividend that I'm going to discuss today. So three things in this video today. First, I'm going to discuss the monthly dividend. I'm going to update on the status of the fund. And then I'm going to end it by discussing whether or not this is a good DRIP or dividend reinvestment play. So stay tuned for all three of those. And this should be a fun video. So right now, QYLD is at $19.60. It's down in the after hours, but it's actually trending slightly down from the start of the year. And if we look how it did in the month of April, so if we're here, if you follow my cursor here, March 31st, April 1st, it was at 21.01. It actually closed the month down, got back to $20, but is back down below it at the end of the month, and it's at about 1960 today. And the monthly payout dropped slightly, not much, but it was noticeable. So let me show that now. If I go to the historical data tab and dividends only, from the start of the, not options, historical data, dividends only. Come on. Okay, so going back to the start of the year, if we look at this, it's still showing historical prices. Come on, dividends only. Okay, so you see it was 21 cents last month, and this month it dropped a whole half a cent to 20.5 cents. And I'm also going to do a partial dividend portfolio update here because you'll see some of my other ones in this because I'm going to show the payout that I got for this. So here it is from April 26th. It was about 43.07, which was down from a month before when it was about 44 something. So, and then if I go to my dividend estimator here, and I have it all sorted already, look at that, 12 months. So it's projected at its last payout. So 43.07 times 12. Now I did some quick spreadsheet analysis, some kind of, ghetto math, quick on the fly, but I prepped. I didn't want to do this during the video. I actually tried to shoot this with doing that and it didn't go so well. So I prepped this time. Okay, so here it is. It's QYLD. Should we drip or not drip into QYLD? So if you just take $100,000 invested in the fund, based on today's price, it would buy you 5,102 shares, and it at a payout of 20.5 cents, or 0.2051, it would pay $1,046 in dividends a month. Yearly, this would be $12,557.14. So it would be about $1,000 a month, or close to the equivalent of the unemployment payout in the state of Florida. But that's neither here nor there. Now, this is really hard math, right? $100,000, what percentage would this be? Just take a crazy wild guess. 12.56%. See? So, and then if you take this dividend sum for the year, which as some say, it's not a dividend, because remember, it's executing a covered call strategy. So it's got covered calls against the NASDAQ 100, and it's paying that out. I don't care what it is, as long as I get a monthly payout, I'm happy. I call it a dividend still, but call it whatever you want. So if you take the $12,557 and divide it by 1960, it would get you 640 new shares. But going over here, see, I have this all prepped out here. And I think by doing this, I might have actually changed my opinion, because what I use these for, I don't currently have anything in the DRIP program. I like the cash to buy other stocks at a discount because everything's free falling in this market. So I like to use the payouts to buy other stocks and not reinvest in this, because over time, this fund is flat and actually slightly down. So I look at it, even though I love the payout, I look at it as a way to fund other stuff. But if you do reinvest this, and holding all other things equal, if it stays about where it is, you come out pretty good. So I ran this table here. So at the starting shares of 5,102, annual payout and then the growth of the shares, and then annual payout from there at 2051, yeah, 0.2051 times 12. And you see, you get all the way down to, look at this, retire early, potentially, all the way to $65,000 a year annual payout if you reinvest at that rate. So I took the 12.5%, and because that's what it would pay based on these calculations, and just basically compounded that every year. See how compound interest works again? Look at this. It's like a snowball again. It snowballs into a bigger payout. So by the time you get to, and I believe I did 15 years here, at the end of 15 years, that's a $65,000 payout, which is the median US income. Now, adjusted for inflation, that, 15 years from now, 65,000 is not going to be worth what it is today. We could do that real quick. Why not? So if you take 65,000, actually, so 8% inflation, right? That 8% inflation won't last every year, but I factor in an average of 4%. I always have. I've always kind of overestimated, but that comes in handy in times like now. Typically, most sites or most financial outlets will say like 2 to 2.5% inflation, but as we know in this environment, those days are long gone. So if I take, just say 1.04% in 15 years, that would be this, assuming I'm doing that right. So that would actually eat away at this. Or you could do it this way. See, like, just if you take 8% out, then this would only be worth this. And then in 15 years, that didn't work. Well, you get the idea. It's going to be worth less over time with inflation. So, not the focal point of this video, but oh, you know what? This. So that would eat away at it pretty fast if that inflation rate stuck at just 4% compounded over 15 years. That would be the real purchasing power of that. But that's not the topic of this video. Overall, I actually, after running these numbers, I don't see the drip strategy as a bad strategy with this. Although I wouldn't do it because I see so many other opportunities to invest, because as other videos like to say, this will not do like what the QQQs will do, or the NASDAQ in general. Once things recover, this isn't a play to equal what the NASDAQ performance is going to do. This is a play specifically for this market. So this example is holding that the fund stays about the same. And what we've seen since 2013, the fund has consistently dropped over time. Well, let's look at that just to be sure. Let's go back here, 2013, because that's what I saw since the fund's inception. It has dropped. See, it was, not much, $5, but since January 2014, $25. And it's, if you map out a trend line here, it's a downward trend. So that example where you are right now, while that looks great, that may not last. And that's why I don't do the drip. But I think that's a good debate to have. Because on paper, looks like a great strategy, but that's if the value of the fund held constant. So keep that in mind if you do the drip strategy with this. And if you like that, please remember to like, comment, and subscribe. Keep an eye out for my next videos. I'm going to be focusing on these funds a lot more because I'm a big fan of them, and a lot of other people are as well. These do well in terms of views and following. So keep an eye out. Thanks so much. Take care.